ARQQ Quantum, swing recovery completed, high probability expansion ahead. Hello, this is top Trader GeneLog. To help beginners, this report is followed by an audio podcast discussion. You can check the full post version on our blog. For better market timing, refer to the real-time index flow shared in our live broadcasts. Subscribe or leave a comment if you want continuous analysis. Need a faster report? Select the priority request option. Summary. After rebounding from a short-term support cluster about a month ago, ARQQ briefly broke below and tested the swing support line, triggering a second wave of upward momentum. Currently, it's testing the upper limit of the short-term resistance, with price tension and volume spike suggesting a potential expansion zone initiation. Investment opinion: ARQQ 2-week price target. Plus 14.8% right pointing arrow $43.60. Probability 70% ARQQ 2-month price target. Plus 38.1% right pointing arrow $52.45. Probability 60% ARQQ long-term price target. Plus 61.1% right pointing arrow $61.20. Probability 45% green circle. The current zone forms a setup of trap break recovery plus MACD flow reversal, making this a high probability continuation area for the existing bullish wave. VPAR chart explanation. Here's the chart for ARQQ Quantum, ARQQ you requested. Highlighted zones represent key technical convergence, short-term trend plus support alignments. These are near swing or mid-term support lines, increasing both probability and expected returns. Each chart carries wave structures and tension zones. Refer to the RHYTHMIX strategy sections for more insight. VPAR rhythm analysis: price has rebounded from the swing support zone after a short-term breakdown. Currently testing the short-term resistance line, near the upper dotted limit, approximately equals 90 halves approximately 3 level. Rhythm structure shows a shift from contraction to expansion. Short-term MACD flow, transitioning from convergence to upward trend. Swing MACD flow, maintaining upward momentum, with upper support forming right pointing arrow. These dual confirmations indicate a strong entry into an expansion phase. Financial flow, including the phrase, ARQQ stock flow and financial status: FY25 H1 revenue, $0.067 million. YoY down pointing arrow 44%. Operating loss, $17.8 million. Net loss, $17.2 million. Cash on hand, $24.8 million. With ATM access up to $75 million. Active contracts. DoD, TIER1 Telecoms license-based revenue expected soon. Right pointing arrow. Financials are weak short-term but backed by sufficient liquidity and pipeline value. News and risk summary, including the phrase key news affecting ARQQ stock: June 17th. Joins Oracle Defense Ecosystem, May 27th. Acquired Amplify IP to strengthen encryption, May 22nd. FY25 H1 earnings, revenue delays, sustained losses. Right pointing arrow. Sentiment is rising but actual monetization still pending. Strategy scenario: bullseye entry zones, short-term buy zone setup. Return to short-term trend, support convergence, trap recovery plus MACD convergence. Entry range, $35 to $36.80. Box range duration, 5 to 9 trading days. Right pointing arrow target, 2-week target at $43.60. Swing buy zone setup. Retest of swing trend, support level. Entry range, $30.50 to $33. Box range duration, 6 to 12 trading days. Right pointing arrow target, 2-month target at $52.45. Midterm buy zone setup. Midterm rhythm base forming. Post-swing line breakdown. Entry range, $27 to $29.80. Box range duration, 10 to 20 trading days. Right pointing arrow target, long-term target at $61.20. Forecast, including the phrase ARQQ stock forecast, currently in an overbought state after recovery from a prior swing low. With support flows confirmed and MACD angle steepening, ARQQ may attempt a new yearly high if consolidation near resistance remains tight. Deep dive analysis: institutional flow. No major buys but momentum pickup evident. Short interest, 7.8%. Trending lower. Community buzz, spike in mentions across Reddit and StockTwits. AI-based flow. Algorithmic sentiment signals expansion entry. Brand notice: this report is based on the proprietary VPAR rhythm analysis methodology.
Welcome back to the Deep Dive. This is the show where we really try to sift through all the noise, stack up the sources, and pull out the most important bits of knowledge to get you well informed. Sometimes with a few surprises, too. Today, we're plunging into, well, a really intriguing case study from the financial markets. And our journey kicks off with this statement right out of our main source. RAI quantum swing recovery completed, with a high probability expansion ahead.
Right.
Now, I know that might sound a bit like a cryptic message from, some Wall Street analyst. And you might be asking, okay, what does that actually mean? And maybe more importantly, why should I care about AR quantum or ARQQ? That's its ticker symbol.
Yeah, that's the question.
Well, that question is exactly what we're tackling today. We're doing a deep dive into this fascinating space where, like, technical stock analysis, the actual financial health of a company, and all that market sentiment stuff. It all comes together around this one company, ARQQ.
And just so you know where we're getting this info, our source material today is, it's like a really detailed analyst report, almost like a private brief,
Okay.
It's absolutely packed. It's got specific financial data, really detailed chart interpretations, the latest news hitting the stock, and even some very specific strategy recommendations, potential entry points, that kind of thing.
Oh,
Yeah, it's quite a find. Gives us a real insider's look at how pros break down and forecast a company's market position.
that's great. So our goal for you today is to cut through all that dense info, the jargon, and pull out those key insights. We want you to walk away with a really clear picture of ARQQ's current spot in the market, what's actually driving its price, and what the future might look like for it. Think of this as your shortcut to being really clued in on this specific case without having to spend hours on charts and financials yourself.
Exactly. And we're going to look at it from, well, all angles. It's not just about spitting out numbers or news headlines. It's about connecting the dots, right?
Right.
We'll dig into the what, the data, the events, but also the why. Why does it matter? We'll link those technical signals to the real-world financials and, importantly, to how the market feels about ARQQ overall. Trying to build that complete picture for you.
Okay, sounds good. Let's start then with ARQQ's recent journey, because the report kicks off with this kind of compelling story of resilience. It says about a month ago, ARQQ bounced back pretty strongly from what the report calls a short-term support cluster. But the interesting bit is it actually dipped below that support level first, just for a bit, like it was testing the waters maybe.
Yeah, it could be.
And then it bounced back hard, triggering what the report calls a second wave of upward momentum. Now, that sounds like a recovery story, definitely. But for our listener, what do terms like support cluster and second wave of upward momentum actually, mean when you're looking at stock charts?
That's a great starting point because it gets right into the language of technical analysis, which is really all about trying to read market psychology through price movements.
Exactly.
So when the report mentions a support cluster or maybe a swing support line, it's pinpointing a price area where historically a lot of buying interest tends to show up.
Like a floor.
Exactly. Think of it like an invisible floor, a level where buyers usually step in and overwhelm the sellers, stopping the price from falling further. Now, what makes ARQQ's recent move interesting, as you pointed out, is that brief dip below the floor. That's often called a trap break. Imagine sellers see the price break that floor. They think, okay, this is it, it's going down, and they rush to sell, right?
Yeah, makes sense.
But then, bam, it quickly reverses and pushes back above that support level. It basically traps those sellers who bet against it. They might have to buy back shares to cover their losses, which adds fuel to the fire, pushing the price up even more.
Okay, so it shakes out the nervous sellers.
Precisely. It shakes out the weak hands, confirms the underlying strength of those buyers who held firm or bought the dip, and then that second wave of upward momentum just confirms it wasn't a fluke bounce. It suggests a renewed, sustained buying interest with real conviction behind it.
Gotcha. So it's not just bouncing. It's like it faked a fall, proved its strength, and then sprang back even harder. That sounds like a pretty powerful signal for chart watchers.
It really is a strong confirmation. And so, bring us to the present. The report says ARQQ is now testing the upper limit of the short-term resistance.
Okay, so if support is the floor, resistance is the ceiling.
Exactly right. It's a price level where selling pressure is expected to kick in. Maybe people who bought lower are taking profits, or maybe sellers think it's gone high enough.
Makes sense.
But what's really critical here, the report notes this test is happening with price tension and volume spike.
Tension and volume spike. Okay, why is that combo important?
Well, think about it. Price tension suggests energy building up, like a coiled spring. Buyers and sellers are really battling it out at this key level. And the volume spike, that's the proof. A lot of shares are changing hands.
Okay.
It tells you this isn't just a quiet nudge against the ceiling, it's a major confrontation. The outcome could be a really significant move.
And this whole situation, this tension and high volume at resistance, is pointing towards a potential expansion zone initiation. That phrase sounds significant. What does an expansion zone mean for ARQQ? What could be coming?
It's a really core concept in this type of analysis, yeah. An expansion zone basically suggests a period of significant price movement is likely coming soon, often quite rapid movement.
Okay.
Think of that coiled spring finally uncoiling. After a period where the price has been kind of consolidate, that's the tension part. An expansion zone means the stock is likely poised for a strong directional move. Could be breaking out to new highs, potentially.
Yeah.
So testing resistance with that high tension and volume, it implies that if the buyers win this battle, the upward move could be pretty powerful and quick. It's signaling a high probability moment for a real shift, breaking out of the current range.
That paints a clear picture. Building pressure, potential release. And what's really interesting is the report gets specific. It gives actual price targets with probabilities. That's not something you always see.
No, it's quite detailed.
Okay, so for the short term, like 2 weeks out, it's predicting a plus 4.8% gain up to $43.60, and it gives that a 70% probability.
Pretty high confidence there.
Then, looking 2 months ahead, it's a much bigger jump, plus 38.1% to $52.45. But the probability drops a bit to 60%.
Still quite confident, but acknowledging more uncertainty.
And then the long-term target, plus 61.1% gain to $61.20, with a 45% probability. So what are these numbers, especially the way the probabilities decrease? Tell us about the analyst's thinking and the risks involved.
Well, it shows a really interesting balance, doesn't it, between the potential upside and the simple fact that forecasting gets harder the further out you look.
Right. Makes sense. More time, more unknowns.
Exactly. That decrease in probability is totally normal, totally logical. More things can happen, economy shifts, company news, market mood changes. But let's look at that 70% for the 2-week target. In the stock market, 70% confidence for a short-term move. That's actually quite high. It suggests a strong belief in the immediate path, likely based heavily on that technical setup we just discussed.
Yeah, 70% feels pretty strong for the market. It's like saying, we're pretty sure it's going to rain this afternoon.
Good analogy. Compared to, there's a decent chance of snow next winter.
Right. Okay. And those percentage gains, 38% in 2 months, over 60% long term. Those are substantial.
They really are. We're not talking minor wiggles here. This suggests the analysis sees potential for a major move, a significant reevaluation of the stock. And while that long-term probability is down to 45%, that's still considered, a pretty plausible outcome in forecasting, especially for that kind of return. It just acknowledges the higher risk. So it's telling you, high confidence in the short-term direction, good potential for much bigger gains longer term, but with, naturally, more uncertainty attached. Which leads us to the next question, right? How do these optimistic targets actually line up with the deeper details, the technicals and the fundamentals?
Exactly. Let's dive deeper into that technical picture then, because the report really seems to hang its hat on it. It mentions a green circle area on the chart.
A visual cue.
And says the current zone forms a setup of trap break recovery, plus MACD flow reversal, making this a high probability continuation area for the existing bullish wave.
Okay, that sounds complex. Let's unpack that. Trap break recovery again, and then what's a MACD flow reversal?
Right. This is where you see the power of combining signals. The trap break recovery, as we kind of touched on, is powerful because it's psychological. Price dips below support, sucks in sellers.
Traps them. Exactly. Then it snaps back above support. It forces those sellers to cover. New buyers jump in, seeing the strength. It basically confirms that support level is really strong. It shakes out doubt.
Okay, got the trap part clearer now. It's like a fake out.
It is. Now add MACD flow reversal. MACD, that's moving average convergence divergence, is basically a momentum indicator.
Right, measures speed and direction.
Sort of, yeah. Think of it like a momentum gauge. A flow reversal here, shifting from down or sideways to clearly up, means buying momentum isn't just there, it's picking up steam, it's accelerating.
Okay, like hitting the gas pedal.
Exactly. So when you get both the trap break showing solid support and resilience, and the MACD reversal showing accelerating upward momentum, analysts call that dual confirmation.
Dual confirmation. Sounds strong.
It's considered very strong. It suggests the upward trend isn't just likely to continue, it's got a high probability of gaining real traction. That's why the report calls it a high probability continuation area. It's a key piece of the bullish puzzle here.
That really clarifies why they're so confident there. Multiple signals agreeing. Okay, moving to the chart view itself. The report talks about key technical convergence and short-term trend plus support alignments. What are these visual things telling us on this bar chart they mentioned? What happens when different lines kind of come together?
Yeah, key technical convergence is when you see several different technical tools pointing to the same price level. Imagine maybe a moving average line, a trend line drawn from past lows, and maybe a Fibonacci level all meeting up around, say, $35.
Okay.
When multiple independent indicators all highlight the same price area as being important, it gives that level much more significance. It's like getting the same direction from several different maps. You pay more attention.
Right, strengthens the signal, like multiple witnesses confirming a story.
Exactly. And short-term trend plus support alignments. That's looking at where the current upward trend line meets up with those established support levels, especially this swing or midterm support line.
Swing support. That's a more major level.
Generally, yes. It relates to a larger price move over weeks or months, so it's considered more significant psychologically. When the price finds support right where the current trend meets these bigger support lines, the report says it significantly increases both probability and expected returns for a move higher. It shows strong demand is right there at that critical intersection.
Okay.
The report also mentions wave structures and tension zones. Technical analysis often looks for repeating patterns or waves in price action to forecast moves, and tension zones are those tight consolidation areas we talked about, where pressure builds before a potential breakout.
So the chart itself is telling a story of pressure building at points where lots of signals agree.
Got it. Let's go even deeper on this rhythm analysis. The report seems to really value this. It says, price has rebounded from the swing support zone after a short-term breakdown, currently testing the short-term resistance line near the upper dotted limit, approximately equals 90 halves, approximately 3 level. Okay, that last part is a bit technical.
Yeah, that sounds like a specific level calculation from their proprietary model. Right. But crucially, it says the rhythm structure shows a shift from contraction to expansion. What exactly is this rhythm structure, and why is shifting from contraction to expansion so important?
This is absolutely central to their bullish view based on this VAR rhythm analysis they use. Think of it like breathing. Contraction is when the market is inhaling, so to speak.
Yeah.
Price movements get smaller, tighter, volatility drops, it's consolidating, maybe building energy quietly, like coiling that spring.
Okay, quiet period, building energy.
Then expansion is the exhale. Volatility jumps up, the price starts making big, decisive moves. It's the release of that stored energy. The spring uncoils.
Okay, so contraction leads to expansion.
Often, yes. That shift is a key signal analysts look for because it frequently precedes and predicts the start of a significant sustained price move. They're trying to catch the market right as it transitions from that quiet buildup to the explosive release.
Gotcha. So if it's shifting into expansion now, that suggests the big move might be starting.
That's the interpretation, yes. And importantly, the report says this shift is backed up by the mass CD flows on different time frames, which adds more weight. It notes short-term maxi flow transitioning from convergence to upward trend, meaning immediate buying momentum is accelerating now.
Okay.
And at the same time, swing maxi flow maintaining upward momentum with upper support forming, meaning the bigger intermediate term trend is also still strong and finding support at higher levels. Healthy sign.
Right.
So you have short-term momentum kicking into high gear and the medium-term trend still firmly positive. That's another dual confirmation. It builds a really strong case, technically speaking, for entering a significant expansion phase. It suggests the recent bounce isn't just noise, it could be the start of something much bigger.
That's a really compelling technical picture they're painting. Very bullish signals stacking up. But okay, let's pivot. Time for the financial reality check.
The numbers.
Because while the charts look good, what about ARQQ's actual business performance? The report states, FY25 H1 revenue $0.067 million year-over-year, down 44%.
I mean, 0.067 million, the $67,000, right? And down 44%. That sounds pretty bad.
It does, and this is where you see that stark contrast we mentioned.
Yeah.
A 44% drop in revenue year-over-year is, well, it's significant. It clearly shows a major challenge in generating sales right now. That's a huge contraction in the first half of their fiscal 25.
Yeah.
And it gets worse. An operating loss of $7.8 million. That means their core business isn't even covering its own costs. And then a net loss of $17.2 million overall.
Wow. So revenue of $67,000 and a net loss over $17 million in the same 6 months.
Yeah. The disparity is massive. It screams immediate financial weakness. They're burning through cash at a pretty high rate. No question about that. That's quite a gap. Definitely challenging present. But then the report throws in some lifelines, some counterpoints. It notes cash on hand, $24.8 million with ATM access up to $75 million. And looking ahead, active contracts, GOD, TI1 Telecoms, license-based revenue expected soon.
How much do these things help? Can they really balance out those losses?
This is really the crux of the investment thesis here, isn't it? Balancing the current pain against future potential. First, that $24.8 million in cash. That's their runway. It's vital. It means they can keep the lights on, keep operating despite the losses without immediate panic.
Okay, so they have time.
They have time.
Yeah.
And the ATM access up to $75 million is also really important. ATM stands for at the market offering.
Right.
It lets them sell new shares directly into the market gradually over time, up to that $75 million limit. It's way more flexible and less disruptive than a big, sudden stock offering. Think of it like a credit line from the stock market they can tap into as needed. It's a major safety net for funding R&D operations, bridging that gap until revenue picks up. That sounds like a smart tool to have, especially if you're burning cash but have plans.
It is. But maybe even more crucial for the future story are those active contracts, specifically mentioning the DoD Department of Defense and TI-1 Telecom, and saying license-based revenue expected soon.
Right, expected soon. That's key.
It is. It means they've actually landed deals with major players. Defense contracts especially can be huge and long-term, even if the revenue takes time to show up on the books. License-based also suggests potential for recurring revenue. This is the pipeline value the report talks about.
The pipeline. What's coming down the track?
Exactly. So the report is very clear. Financials are weak short-term, but backed by sufficient liquidity and pipeline value. It's acknowledging the current struggle, but highlighting the financial staying power and the tangible future contracts as major mitigating factors. It's that classic growth company story. Lose money now to build something valuable for the future. It's definitely not a simple good or bad picture.
Yeah, it's a very nuanced situation. Struggling now, but with cash, a way to get more cash, and confirmed future business on the horizon. Okay, let's bring in external factors. News, risk, sentiment. The report flags a few recent news items. June 17th, ARQQ joins Oracle Defense Ecosystem. May 27th, acquired Amplify IP to strengthen encryption. And then May 22nd, the FY25 H1 earnings revenue delays sustained losses, news we just discussed. How do these pieces fit together? Positive, then negative.
It's a fascinating mix, isn't it? And it really shapes how the market sees the company right now. Let's take them one by one. Joining the Oracle Defense ecosystem, that's potentially huge.
Why Oracle specifically?
Well, Oracle's a giant in enterprise tech, and their defense work is serious business. Being part of their ecosystem gives ARQQ credibility, validation. It could open doors to significant defense contracts, which are notoriously hard to get into but can be very lucrative and stable long-term. It signals they're playing in the big leagues, strategically.
Okay, so that's a big positive signal for future business.
Definitely. Then, acquiring Amplify IP to strengthen encryption, that's another smart strategic move. For a company dealing in quantum tech and defense, top-notch encryption isn't just nice to have, it's absolutely critical.
Right, security is paramount.
Exactly. This shows they're actively investing in making their core technology better, more secure, more competitive. It enhances their product offering for those high-stakes customers.
Okay, so two solid strategic wins. Looks like they're building for the future.
Absolutely. Clear forward momentum on the strategic front. But then, smack, you get the May 22nd earnings news, the revenue delays, the losses.
The reality check.
The reality check. It grounds all that strategic optimism. It confirms the financial weakness we talked about, and maybe explains why things are delayed. It costs money to innovate and land big deals. It's the here and now financial picture contrasting sharply with that future vision.
So you've got this real tension. Good news about the future strategy, bad news about the current finances. And the report boils this down nicely. Sentiment is rising, but actual monetization still pending. What's the significance of that gap between feeling good about the company and the company actually making money?
Oh, that gap is critical. It's where a lot of the risk and opportunity lies for growth stocks. Rising sentiment means the good news Oracle Amplify IP is working. It's creating buzz, optimism, excitement among investors. People are buying into the story, the future potential, and that drives the stock price up, sometimes way ahead of actual earnings.
Right, buying the promise.
Exactly. But actual monetization still pending is the necessary anchor to reality. The positive developments haven't yet turned into dollars flowing onto the bottom line. This creates that tension you mentioned. It's the market's perception versus the company's current financial performance. And the risk is clear, right? If that monetization takes too long, if those contracts don't start generating revenue as expected, or if there are more delays, that positive sentiment can evaporate pretty quickly, and the stock price could correct sharply. Investors are betting on execution, and execution always carries risk.
That makes a lot of sense. That sentiment monetization gap feels like a tightrope walk. Okay, let's widen the lens a bit more beyond just official news. The report's deep dive analysis section brings in things like community buzz, spike in mentions across Reddit and stock twits, and also AI-based flow, algorithmic sentiment signals, expansion entry. What do these more modern indicators tell us?
Yeah, this shows how market analysis is changing, incorporating these newer data streams. Community buzz, especially spikes on places like Reddit or StockTwits, that's the retail investor crowd getting interested.
The meme stock effect, potentially.
Well, it can be, though not always. But it definitely shows growing awareness and discussion among individual investors. These platforms can genuinely move stocks short-term. So a spike in mentions means ARQQ is on the radar of that potentially powerful group. It's collective interest building momentum.
Okay, so the internet crowd is talking about it.
They are. And then you have the more sophisticated layer. AI-based flow, algorithmic sentiment signals. This means complex computer programs are scanning everything, news, social media, trading data, you name it, in real time to gauge sentiment.
Oh, right.
And if these AI systems are flashing an expansion entry signal, it suggests their algorithms are also detecting patterns that point towards a strong potential price increase. It's like getting a confirmation from the machines based on data processing far beyond what humans can do quickly.
That's fascinating. AI agreeing with the bullish technicals. What about the big money? The report said no major buys from institutional investors, but also momentum pickup evident. What's that mean? Are the big funds interested or not?
It's nuanced. No major buys means you're not seeing huge funds filing paperwork saying they just bought a massive chunk of ARQQ. They might be cautious because of the current financials, or maybe their investment rules require profitability first. Institutions often move slower.
Okay.
But momentum pickup evident is key. It suggests that even without those huge buys, the underlying price action and the buzz we've talked about is building. It could mean institutions are watching closely, maybe taking small initial positions under the radar, or just getting ready to jump in if things solidify. It implies ARQQ is on their watch list, even if they haven't fully committed yet. The momentum might attract them soon.
So retail and AI are keen. Institutions are maybe warming up on the sidelines.
That seems to be the picture. And one more piece. Short interest, 7.8% trending lower. Short interest is the percentage of shares bet against the stock.
Right. People betting it will fall.
Exactly. If that number is trending lower, it means fewer people are making those negative bets. Some might even be buying back shares to close their shorts. That reduces selling pressure and is generally seen as a bullish sign, less conviction among the bears.
Okay, so multiple fronts, retail buzz, AI signals, potential institutional interest building, fewer bears, all kind of leaning positive, despite the lack of big institutional buys yet. Which brings us neatly to the strategy part, the really practical bit. The bullseye entry zones.
Yes, this is where the report gets very actionable, offering specific setups based on all the analysis we've discussed. Precise ranges, targets, time frames, tailored for different approaches.
All right, let's break them down. First, the short-term buy zone setup. It looks for a return to short-term trend support convergence, trap recovery, plus MACD convergence. Entry range, $35 to $36.80 sets. Duration, 5 to 9 trading days. Target, that 2-week goal of $43.60. What's the play here?
This is definitely for the quick tactical trader. It's basically saying, wait for a specific kind of pullback, not just any dip, but one that comes back to a confirmed short-term support area where multiple signals line up. Convergence.
Okay.
Then you want to see that trap recovery confirming the support is strong, and the MACD convergence showing momentum is turning back up right there. It's about catching a confirmed bounce off a strong level for a quick move towards that $43.60 target. High probability, short time frame. Ideal for active traders who can monitor closely and act fast on those specific signals.
Got it. Wait for the confirmed dip and recovery signal, then aim for the short-term target. What about the next one? The swing buy zone setup. This targets a retest of swing trend support level. Entry, $30.50 to $33. Duration, 6 to 12 trading days. Target, the 2-month goal of $52.45. This sounds like waiting for a bigger dip.
Exactly. This is for someone with a slightly longer horizon, aiming for a larger piece of the potential move. A swing trend support level, remember, is generally stronger or more significant than a short-term one.
Right, related to a bigger price move.
Yeah. So this strategy involves waiting for a deeper pullback, potentially offering a better price, a lower entry point. The idea is to get in closer to that more substantial support for a multi-week hold, aiming for that bigger $52.45 target. The probability is slightly lower, 60%, but the potential reward is much higher. Suited for a swing trader, someone comfortable holding for weeks, not just days, trying to capture that larger upward swing.
Okay, deeper pullback, bigger target, slightly longer hold. Makes sense. And the last one, the midterm buy zone setup. Lowest entry range here, $27 to $29.80. Longer duration too, 10 to 20 days. Target, The long-term $61.20 goal. This is described as midterm rhythm base forming post-swing line breakdown. Sounds like waiting for a potentially serious weakness.
It does. This is the most patient and potentially highest risk, highest reward entry. It anticipates a scenario where the price might actually break below a major swing support line, maybe due to market fear or some temporary negative news, a significant shakeout. The strategy then is to wait until after that breakdown and watch for a new base to form, a period where the price stabilizes in that lower range, $27, $29.80, showing the selling is exhausted and buyers are stepping back in to build a new foundation.
Buying after the storm has passed and things settle down.
Precisely. If you can catch that new base forming, you could get the absolute lowest entry for that potential big move towards $61.20. But it requires patience, discipline, and the nerve to buy when things might look scary after that breakdown. And you risk the breakdown continuing, of course. But for a long-term investor willing to ride out volatility for maximum upside, this could be the most attractive entry, assuming the core bullish story remains intact.
Wow, 3 very distinct strategies there, tailored to different risk levels and timeframes, really practical stuff. So bringing it all together, what's the overall forecast? The report says ARQQ is currently in an overbought state after recovery from a prior swing low with support flows confirmed and MACD angle steepening. Now, overbought usually sounds like a warning sign, right? Time to sell?
It often does, yeah. Overbought usually means the price went up fast, maybe too fast, and a pullback could be coming. But context is everything here.
Okay.
The report immediately qualifies it with support flows confirmed and MACD angle steepening. Support flows confirmed means buyers are still actively stepping in even at these higher prices. Demand is strong. And MACD angle steepening, that means the upward momentum isn't slowing down, it's actually getting stronger, accelerating.
So it's like, yes, it ran up fast, but the engine is still revving harder, not sputtering.
Exactly. It suggests the buying pressure is so strong it might just keep pushing higher, overriding the typical overbought pullback expectation. It's a high energy state.
Gotcha. And the conclusion, it says, ARQQ may attempt a new yearly high if consolidation near resistance remains tight. What does that tight consolidation look like, and why is it important?
Tight consolidation near resistance means the price hovers just below that ceiling level we talked about, maybe trading in a very narrow range without any sharp drops. It's like the buyers are patiently absorbing any selling that comes in at that level, building pressure steadily.
Like water building up behind a dam.
Good way to put it. If it can stay tight like that without backing off significantly, it builds enormous pressure for potential breakout through resistance. If that happens, the path could be clear for a move to a new yearly high. It's laying out the specific condition that tight consolidation needed for the most bullish outcome to play out. It's that sophisticated, if this, then that analysis.
Fascinating. Well, we have certainly covered a lot of ground today on ARQQ. We've gone through the specific price targets, the probabilities, dug into those really specific technical signals, trap breaks, MCD reversals, rhythm shifts. We've looked hard at that contrast between the weak current financials and that strong future potential from the pipeline and liquidity. And we explored how news, sentiment, algorithms, institutional flows all kind of mix together. It's been a real multi-layered look.
And that's really the goal, isn't it, for you, the listener, to see how all these different pieces, technicals, fundamentals, sentiment, get woven together to build a full picture. It's about understanding how they interact. How strong liquidity and a good pipeline can offset weak earnings for now, how powerful chart patterns can suggest future moves even when the current numbers aren't great. It gives you that holistic view, which is just crucial for making sense of the market, seeing the whole puzzle, not just the pieces.
Absolutely. So as we wrap up this deep dive on ARQQ, here's a final thought for you to chew on. Given this situation, weak financials now, but a strong pipeline, good liquidity, and this compelling technical setup suggesting expansion, how do you weigh that promise of future revenue against the reality of current losses? When you're looking at a company's path, where's the balance point for you between betting on the future and seeing those present red flags?
And maybe add this layer too. For a company like ARQQ in these advanced tech fields with potentially strategic government links like the DoD contracts and partnerships like Oracle, how much weight do you give that strategic importance? How much is that potential worth, the value of the technology, the partnerships, even if the big money isn't flowing in yet? It really makes you think about how the market values innovation and future promise versus cold, hard cash flow today, especially in these potentially world-changing tech sectors.